Hello, my name is Mike Smith. I'm the president and founder of T&K Futures and Options Incorporated. And today's educational video is going to be about copper futures and options. But before we get started, let me go ahead and cover the risk first. Futures and options investing carries significant risk of loss and is not suitable for some investors. Past performance is not indicative of future results. And you should only use risk capital when investing in these types of investments. Okay. I've been doing this going on 22 years, 20-something years now. I've heard a lot of questions, but they typically boil down to about 5 basic questions that I hear over and over again. And I want to cover those questions for the copper market here. The first question I typically get is, how does margin in the futures work? Yeah, it confuses people. Margin is basically just a good faith deposit that the exchanges set those rates for the particular commodities. So let's say that it's copper market and it's extremely volatile. Market's really moving around quite a bit. Typically that happens near a top. And let's say that here's what the margin is today, is $31.90. If it was getting super volatile, they might raise it. It might be $5,000 or $6,000 for a contract. And conversely, let's say it was really slow and there was low volatility in the market. Well, they might actually lower that contract. It might actually go down, and they try to stimulate more people to get into that market. So the exchanges use margin rates to kind of manage the volatility of the various futures and options. But let's go ahead and let's go through some hypothetical examples of how you would do that in the profit and loss. Okay, let's say you want to get long 1 July copper contract. Okay, you opened yourself a $50,000 account. The margin today is $3,190 as of this video. That's your initial margin you got to put up. That money goes on the sideline. So you have $46,810 of available equity left over to either leave in there in case the market moves against you. You can put more contracts on. You can buy options. Whatever it is you're looking to do. But that's the only amount of money you have on the sideline because it's on the side for that one contract. Okay. Here's the contract specifications for copper. It's a 25,000 pound contract, and that means every penny moved is equal to $250. The symbol is HG. Okay, let's say you went in here with your new account and you got long 1 July copper at $3. I made those numbers up. Copper's not at $3 today. But anyways, let's say you did. Okay, you got in there at $3 a pound. For your copper, and the market went up 10 cents real quick. Well, that's a good day for you. Every penny is $250 times 10. That's a $2,500 day you just had there. That's pretty good. Okay, let's look at the other side of the equation now. Let's say you got in there and the market's at $3 and boom, it came down 10 cents. Well, now you just lost yourself $2,500. And that's where this comes in. I don't know if you can see that, but it says infinity risk. Theoretically, you have unlimited risk to the upside in a commodity trade because there's theoretically no end to how high numbers can go. No one's ever lost infinity. But there is a lot of risk, and that's what you need to take out of this is futures are very risky. To the downside, a commodity can only go to 0. So, it's finite to the downside, your risk, but still quite substantial. And that actually leads to the next question I typically get is, I've heard these horror stories about commodities, or futures anyways. How do I manage my risk? In my opinion, the best way to do that is with a sell stop order. And I'm going to explain how that works. So let's say you got in here again, you went long at $3, but it's going against you. It's down to $2.95, $2.90. As soon as it sells through that 290, as soon as it trades through that 290 level, it turns into a market order. And the way a market order works is you're going to get the next available price. Okay? So that's why I want to have risk here equals 2,500-ish. So we had a 10-cent stop below, which is 2,500, but you don't really know what that next available price is going to be. That's why I put the ish there. Next available price after it turns into a market order might be 291. Might be 289. You don't know. You just don't know. So it's not precise. It's an ish. But it is, in my opinion, the best way to limit your risk is with that sell stop. The next question I typically get is about options. And it's basically, what is a call option? Well, a call option gives the purchaser the right but not the obligation to buy the underlying futures contract, which is this July copper, for a specified period of time, July, at a specified price, 310 in this hypothetical. Okay? And to pay for that, you're going to have to pay something. Your premium, I made this up, I said 3 cents, which would be $750. Okay, so that means you bought this option right here. The market, let's say the market was at $3 and you bought this 310. And let's say you actually had that day where the market went straight up, 10 cents. Okay, that's a $2,500 move, but you're not going to catch that because options do not catch the entire futures move. They only catch a percentage. And, you know, I made these up too. What dictates how much you're going to catch is going to be your delta factor. So, again, I made this up. But let's say that this 310 call had a delta factor of 25%. Okay. Market went up $2,500. You're not going to catch that $2,500, but you're probably going to catch approximately 25%, which is $625. That's 25% of the 2,500. Now, I don't know if you can read this or not, but there's an ish next to that because that's changing too. As the market's moving up and down, your delta factor is increasing and decreasing as the market moves. There's other variables in there. There's time decay, which is your theta. There's vega, which is your implied volatility, volatility premium of the option. So there's a lot of factors involved in options. It's not cut and dry like the futures market is. That's why people get confused a lot when it comes to options. But okay, so that's how that would work, your profit and loss scenario, using the delta factor with this hypothetical situation. The next question I typically get is, what's a put option? Well, a put gives the purchaser the right but not the obligation to sell the underlying futures contract. People understand buying low and selling high and making the difference, but what they don't understand quite often is you can sell high and buy back low and make the difference as well. So it's a zero-sum market. You got betting higher and lower. There's no bias or anything like that, like you might see in the stock market, where a lot of these situations, it's real hard to go short a market. It's not hard to go short a market in the commodities. Next question I typically get is, what is my risk when I purchase an option? Well, your worst case scenario when you purchase a call or a put is losing whatever the premium you paid. In this hypothetical one, it was $750 plus whatever your commissions and fees were. So that's your extreme worst case scenario, is you can lose it all if the option expires worthless. And they have expiration dates. Let's say with this one, it's probably going to expire. I'm making this up off the top of my head right now, but I should have looked up the expiration date, but I didn't. That's going to probably expire in the middle of June sometime. It's going to be the month before for this one. So you'd have now, whenever you purchase it until then, to either cut your losses or lock in profits and get out of there. If not, and it's out of the money, so even if it was at 309.90 at expiration, you get zero because you're not in the money. There's no intrinsic value there. So that's how you lose on an option. That's your worst case scenario. If you have any questions, you can give me a call. You're probably on this website right now, but if not, it's tkfutures.com. My name again is Mike Smith. You can find my contact information there. I wrote a book called The No Nonsense Guide to Buying and Selling Options. You can get that on Amazon. It's all about options. It doesn't cover futures at all. Also, you might even want to try one of our practice accounts. Get real-time quotes and charts, practice this without risking any real money. That's another way to learn how to trade these markets, but that's about it. That is it. I hope you enjoyed it. I hope you learned something, and have a nice day. All right, bye-bye.